All right, welcome everyone to our channel here. I'm John Madison. I'm the Vice President of Marketing here at FFR Trading. And today we've got a special guest, Keith Harwood, one of the esteemed traders here at FFR Trading. FFR Trading is a due diligence firm. We vet traders and their strategies to bring retail traders, verified traders, and their strategies to follow them and learn. It's what we refer to as learn and earn programs. Well, Keith Harwood is one of those traders we think you'll be hearing more from in the future here. Keith has an impressive background in trading, and we're excited to dive into his insights and strategies here. So Keith, thank you for joining us today.
Absolutely.
So first, provide us with some background info for those watching that may not be familiar with your work and what you do. You know, I always say in an industry full of gurus, your background has always stood out to me. So share with us some of your background, both education and kind of work experience as well.
Absolutely. Thank you again. So I started out at the CBOE in 2005 as a market maker. So graduated from the University of Notre Dame with a degree in theoretical math and economics. So very analytic focused approach to the markets. A lot of people trade off of feel, and I always try to put some numbers behind things. So I do a lot of work with statistics and regressions and things like that. Just trying to get a lot of numbers behind it so I can really understand the expected value of a trade. But I think one of the dangerous things that a lot of people with an analytic background is start to put those numbers as being like hard truths. And you have to understand that the market is its own sort of living, breathing thing that moves irrationally at times. It doesn't always follow the analysis. So, trying to basically combine those sort of elements. And, with the almost 20 years of experience now, I've seen a lot of interesting market environments. Of course, the subprime crisis was really where I dug in and started up with the market. We had this massive collapse of the economic system, and I was a market maker in the pits, just trading what the flow was doing, watching the VIX explode to insane levels, and then completely reversing course and just grinding higher for, God, it feels like 15 years now. It's just been a grind, and it really kind of has been. I mean, there hasn't been too much of a hiccup other than a little bit really right at the beginning of COVID, and that turned out to just be an opportunity for growth, it turns out, for the market. So, but anyway, so I've been a market maker. After the subprime crisis, I started as a proprietary trader. I was trading gold, silver, fixed income products. I got my MBA from the University of Chicago and then went to work for a CTA, which is a commodity-based hedge fund. And that's where I learned a lot more about technical trading. And I actually really like technical trading because while fundamental inputs happen somewhat frequently or rarely in certain cases, earnings are quarterly, not daily. Technical inputs can happen any day, and they're not always priced into the market, especially the options market for a potential big mover. And that gets me really excited about finding a edge that the market may not be pricing in. So about 7.5 years ago, I started working as an educator, exclusively working with traders of basically any trading experience, from brand new to their hedge fund managers, and discussing with them how I look at the markets, how they can understand options better. And really the main goal for, I think, everybody is to trade smarter. Look for that opportunity and figure out the best way to leverage, but also define the risk of the trade that you're looking for.
And some excellent points that I do want to kind of dive a little deeper into. But first of all, you were talking about the kind of the markets where they were and where they're going. What is your current kind of outlook for the overall stock market now that, I think S&P maybe ticked another all-time high today? What's your outlook here?
Yeah, I think generally speaking, it's hard not to be bullish the market on the long term. There are going to be moments where you can have a short-term blip, a short-term problem. The market gets overbought. That's not bearish. It just means that the market is moving too fast. So it needs to consolidate and then rotate. Maybe we get sector rotation that causes some sort of fear. Semiconductors led the market for really most of this rally because they're what powers computers. But at the same point, that doesn't mean they're always going to lead. There could be other things that lead. And when they get ahead of themselves, they can take a little bit of a pause and people can look at other sectors. you may find periods of time where people really like retail companies or really like financials or really like biotech instead of semiconductors. It doesn't mean semiconductors are bad. It just means they're overpriced relative to other companies out there. So for me, though, I mean, I think, turned our entire nation's economic policies into a goal of making the market go higher. It feels like whether the economy is in great shape or not, the market always seems to go up. So it's really hard to fight that and say that I'm bearish, but I'm always looking for that input that could cause me to change my mind. And right now I just don't see one.
So, interesting. Now, let's kind of talk about the economic factors that might be influencing some of those trends. How do you see, some of the recent economic indicators like, maybe GDP growth or the employment data, obviously inflation numbers that are coming out? How does that play into all this and influence your market outlook?
Yeah, I mean, basically, we're still seeing growth basically everywhere. I think the biggest thing that everybody's looking at is inflation. Inflation could be that real problem. If inflation gets too high, interest rates need to rise. And then we've got the opposite of what we had, 7 years ago. Everybody talked about this market that, for those of you that weren't in the market then or don't remember, it was TINA, TINA. There is no alternative. Interest rates were zero. So where were you going to get growth? You were going to be buying the market. And if you wanted some sort of fixed income-like product, you bought stocks that pay dividends. Well, now that the interest rates have risen, there is a need and a desire to have a little bit more balance in that portfolio. And if interest rates rise enough, I would rather take the risk-free rate than the risky stock market return. Long term, we've proven over almost any time horizon in the long term that the stock market does grow faster. But, as you get people closing in on retirement or needing capital, there will be a reason or a rational behavior to have some bond exposure and fixed income exposure. So for me, as long as I see that inflation data not getting out of control again, and interest rates staying relatively reasonable so that people aren't feeling like they have to flood out of the market and into bonds, I still think that we're going to see the market go higher. Things can change, of course. There could be another pandemic or it could be a war or something like that that could change the whole system. But for now, it's inflation, and what the Fed does with that.
And what is your outlook for that? I mean, we kind of headed into this year thinking we were going to get a few rate cuts, and now we're thinking maybe we're not even going to get one before the year's out. What is your outlook there? Given the situation, I think the Fed was just speaking today. I didn't get to hear all the testimony, but what's your outlook there?
Yeah, as long as we don't see the market start to fall, I think that they're okay with not cutting. They want to cut, though, when they start to see the market fall. So there's this wiggle room that they've got by not cutting now. It means that you can cut later if you don't cut now. But if you start cutting now, part of the fear for a lot of people coming out of the subprime crisis is what happens if we have a double dip recession? You're already at 0% interest rates. You've got nowhere to go. Right now, you've got somewhere to go. You can cut if you start to see recession indicators. So I still believe that they're going to get those cuts in once they start seeing inflation data subdue. And I actually think some of this is going to be interesting as we lead into the election, which is another topic I know we're planning on talking about. But, if inflation subsides, and I actually think that a lot of Trump's policies were bearish on oil, for example, and we saw a massive rally in oil prices as soon as Biden got elected from November of 2020 up for about a year and a half. We almost had a straight line up in oil prices. I think some of that could come back down, showing less inflation to people and also giving people some confidence that we could start seeing some rate cuts with that.
Interesting. So you think maybe heading into next year, assuming inflation kind of remains under control, so to speak, that we might get rate cuts starting next year, or do you think maybe the end of this year that's still on the table?
Yeah, I think at the end of this year it's still on the table. But I think for me, actually, one of the things that the Fed wants to have is they want to have that option of the cut. So as long as the option of the cut exists, then we can continue the stock market higher. So it's kind of one of those things where as soon as they start doing it, you've eliminated one cut that they could do later because they did it today. So it's actually almost better for the market to have those cuts in the back pocket as long as the market's going higher. they, I think, will be less or more reluctant to cut until they feel like they have to. So I think right now there's a good likelihood of getting a cut this year, just because at some point you got to do another one. But I think holding on to more cut and having the option for it is an important part of the market.
And do you think when the Fed does decide to cut, do you think the markets will look at that as there's a problem with the economy and they need to cut? Or, is this just part of the soft landing that the Fed is trying to orchestrate here? And do you think that they'll achieve that?
Yeah, well, honestly, it's kind of funny to watch those things, because sometimes when that news comes out that they do have the cut, the initial reaction might say, oh, this is great, we've got a cut, buy more stocks. But that actually creates a short-term top, because now you know that for X amount of time, there's not going to be another cut. You've done it. It's over with. It's kind of that sell the news factor. So, you buy the rumor, sell the fact. And at the end of the day, I wouldn't be surprised to see an initial spike on a rate cut decision, followed by a pullback as people start to say, well, this really doesn't change anything. It was probably already priced in when we get close to it. A lot of the rhetoric leading up to that cut is made sure to be very clear to the public, because the Fed wants to really give you their game plan ahead of time and then execute on it. Because when they give you the game plan and then deviate, that's where the market really can panic, I think.
Gotcha. So let's kind of shift gears a bit and start delving into maybe some sector-related performance. Yeah. Which sectors do you believe will outperform or underperform the markets in the coming months?
Yeah, so in the coming months, I think that where we're at right now, it still seems to be a very tech-led market. Semiconductors, I think, are still doing very well. The last few days, we've had major rallies in AMD and Intel. NVIDIA is always a favorite for people. We're coming into earnings season, though. So if we start seeing some negative earnings out of semiconductors, that could start to give a pullback in tech and then a rotation into other sectors. I think that, honestly, I've been looking for a bigger rally out of financials for a while now, and we really haven't had a major move in financials. We've had some rally, but nothing near what we've seen in some of these other sectors. They're some of the first ones to do earnings. If those earnings come out bullish, that could set up a new trend for the rest of the year, in financials being a new sector to allocate to. So those are two of my primary ones to look at right now. I had been for a while looking for energies to rally, but the more I think about it, if I'm expecting Trump's odds of winning the election to increase, and my expectation on that would be for bearish oil, we may just never see that oil move after all for these stocks coming into the end of the year. So if something changes in the election forecast and all of a sudden we start seeing Biden's odds increasing again, then I can look back at the energy sector as well.
So that's a good, I think, lead into kind of getting into the kind of broader global landscape and the geopolitical influences. How do you, obviously we're coming into an election year here. It's, kind of gearing up to be a really unpredictable, probably one of the most unpredictable elections I think we've probably faced in a long time here. How do these events and this upcoming, election, how does that, impact your market outlook, and how do you kind of prepare for that?
Yeah. So what a lot of people do going up to the election is similar to what you would do for an individual stock going into earnings. A lot of people trim positions. So that actually could cause a little bit of market action in the next 3 months, 4 months, where people are trimming some of their tech exposure just in case. If there's certainty into the election where we're, 99% sure it's going to be Trump or 99% sure it's going to be Biden, people are going to be a little bit more willing to take some risk going into the election. But if there's still kind of a coin flip, I think that the risk will be reduced, and people will, or people will use options to, hedge or leverage and define that risk. So one thing that we often see going into a big event like earnings or an election is implied volatility in the market rises, because options are really an insurance contract. So you're going to insure against the unknown. If the unknown is actually a known, that insurance premium probably doesn't come in. and people just kind of go about their daily business with market rotation. And like I said, I think that, some of the biggest things could be in the energy sector, and then maybe into the financials and things of that nature if we're getting big moves in bond yields. So for me, a lot of it's preparation based upon the odds. Right now, I think that the odds are looking more and more in favor of Trump, but maybe something changes at the next debate, or if something changes where Biden ends up pulling out of the election after all, and we end up with a completely different candidate, that could actually create some volatility in the market, because if everybody's been positioning for a likelihood of Trump, and then all of a sudden the expectations that Michelle Obama is going to end up winning, that's a complete change of what we're looking at in the markets.
What do you think the markets, in terms of who gets elected, how does that affect the markets? Do you think, a Trump victory is good for markets, or, the market's been doing well under Biden? Does things continue if Biden gets reelected, assuming he's going to be able to follow through on all this? Do markets just continue, or do we get some? I was reading about George Soros. I understand he's got a very bearish position in the market right now heading into the election. We know Warren Buffett's probably sitting on more cash than he's ever had. Now he'll put it that it's due to there's really no value for him in this market, and he's probably got to wait for prices to come down. What are your thoughts, on, how these, how the election goes, how that affects markets here?
Yeah. So for me, one note, I've heard that a few times from Berkshire Hathaway and Buffett, where he says that he likes to sit in cash right now. He just doesn't see the value in the market, or he goes out and says, I'm going to start buying Berkshire Hathaway stock back from investors because that's the best value in the market. Mm-hmm. At the end of the day, somebody is seeing value somewhere here, and that's what's causing the market to go up. Maybe it's just computer programs finding the value, but following the trend, it's hard to fight against a one-directional trend like this. I think that there's a certain element or an expectation that, Trump always says America first, America first, America first. So it's more of a sector or global, what do you want to call it, like a global country choice when you're looking at the market, depending upon who wins. So if America first is a reality, then American-based companies should outperform if Trump can realistically change some serious policies in there. If not, you could look more globally. There's always going to be impacts on countries like China or emerging markets, depending upon how the election goes. But I think that more than anything, what you're saying is right. Market went up under Trump. It's going up under Biden. Right now, the market it's kind of built to go up. And I feel like I got to be missing something. There's got to be something that can drive this market down. But everybody wants the market to go up because that they can then raise their hand and say, I oversaw the market rally of 100% over 4 years. The market doubled while I was in the office. Wouldn't you want to reelect me? And if it happens, no matter what, it's just a matter of which sector can really dominate. So whether it's tech or small caps or financials or any of these other names.
When speaking of these emerging influences, obviously AI is a hot topic these days. So let's kind of explore that a little bit. How do you see the integration of AI affecting specifically options trading? You seeing anything in that space?
Yeah, so I think artificial intelligence is great. It's basically increased the power of the computing that we've already had going on in terms of finding trading strategies and trying to take advantage of opportunities that are present. When I started, we were just getting into electronic trading instead of most of the options trading being open outcry. So people had, printouts of their option values, not a computer program updating, thousands of times per second on the new value of the option and making sure to create the new markets. As these new tools come out, we tend to increase efficiency, but we also, for smaller trades, but I think that we oftentimes decrease efficiency on larger trades. So one of the things that I remember seeing back when we went from trading in nickel increments in the markets to pennies was that liquidity was bigger. There was greater liquidity for small trades, i.e. tighter markets, but somebody that wanted to put on a large position ended up actually paying a higher price because there were fewer people willing to provide large amounts of liquidity. Things like that can certainly come up with AI, because AI-based strategies I expect to come into the market initially smaller, testing the waters, seeing how they work, making sure that there's no big hiccup. But when they're trading smaller, it means there's less liquidity. So when somebody really needs to move, there's a big news event, anything global, a pandemic, a terrorist attack, things like that, that I hope we don't see again. But those things can really drive the liquidity in the market really fast and cause computer programs to act irrationally because they don't know how to respond to irrational inputs when they're being fed lots of rational inputs over time. I think over time, in the long run, AI is going to be great for the markets in terms of how they operate efficiently. But at the same point, they could create some hiccups in the short term. So, it's another tool for me, though. I think that these are great tools for those of us that are trying to develop trading strategies, because I can sit there now and backtest a trading strategy in seconds instead of taking weeks or months to try to figure out what's working in the market right now. And that's very powerful for people like me.
So it kind of leads me into, are there any of these AI tools or technologies that you're finding particularly useful in your trading strategies? I think you mentioned backtesting. Is that making that process a lot quicker, a lot easier? Probably incorporating a lot more data at the same time.
Yeah. So, we're doing a lot of our stuff in-house, proprietary trading models and things, because then we can control them and modify them as needed. If I go out to a big company and say, hey, I'd like you to implement some tools to understand more of these specific trading concepts that really apply to me and a handful of others, it's going to be a low priority. But when we know that that's good for us in-house, we certainly can go through that. So over time, I'm sure that, the big guys, the Microsofts and everybody else, are going to have basically everything built into their AI models. But the higher priority for our trading firm is to have trading specific artificial intelligence. And like you said, it's backtesting. It's pulling fundamental data. If I wanted to know out of the S&P 500, which stocks have earnings in the next week, it's really easy to filter that out using AI by simply asking it, which stocks have earnings in the next week. Before AI, I would have sat there and had a spreadsheet that had all of the companies, been using an API to pull in the earnings data and then sorting by that earnings date. And that takes a little bit of time. It's not a lot, but not everybody knows how to, type in the right Excel formula. Everybody knows how to type a sentence saying, what stocks have earnings in this week? And so I think the AI is a very powerful tool to give a lot of people a power that they didn't have before in terms of filtering data. And hopefully they use it the right way and don't get overconfident in what AI spits out when they do back testing and things like that.
So how reliable do you think these AI-driven, as far as it's like predictive analytics, like in forecasting market movements, is that real? Is it something you can measure? Is it just no better than human? What are your thoughts, or what are you seeing out there when it comes to AI and forecasting ability?
Yeah, I think that, the forecasting ability is that I've seen from some of the programs that I've been looking at have been fairly good. Everything follows like a distribution for those of you that are in the statistics world. If you predict something, it's not predicting it to happen 100% of the time. It's saying this is the most likely occurrence, or this is something that I expect to see happen 65% of the time. So then it's about structuring the trade and knowing how to do that. And, going through AI can help give some option structures to specific trades. But I actually prefer to use the artificial intelligence to kind of give me that predictive element, give me some sort of idea of where I think a stock can go. And then I can test out a few different option strategies to align with that and see which historically have given the best return. Unfortunately, that means then that after that, you have to put it live and see how it goes, and that means time. So you can backtest anything you want and overfit the data, but until you've actually put a strategy live to the market and then watch time pass, you don't know for sure if it's working. I can give you all of the backtesting in the world to have a perfect trading model, but that doesn't necessarily mean it's going to work in the future, because you can overfit data to say that butter prices in India are the most relevant driver of economic growth.
So in what ways do you think AI may be changing market behavior, or eventually may change market behavior and the dynamics of the markets?
Mm-hmm. Yeah, so it's when we saw markets go into electronic trading, a lot of the trading participants really converted from being, guys in the pit bullying around and knowing a lot about a specific option or specific stock, or just being a big guy. I mean, you think about what people had from other movies in the past, the Wall Streets, the Trading Places. You always had these people that were very, very financially savvy about their market, understanding what was going on at the core. I remember years ago talking to a guy, and I asked him what his model was spitting out for sugar. And he said, "Oh, what's the symbol for sugar?" So he didn't even know what symbol it was. He just knew that his markets were traded based upon inputs in the computer. Well, because AI is easier to use for the layman or the person that doesn't know C# or Python programming, I think we can have a little bit of a conversion back to people that have a more financially based education in there. That's not necessarily a good or bad thing. It just means that maybe there's a little less need for the super advanced programmer from actually creating the strategies versus supporting them.
What risks do you think may increase as the use of AI in trading increases?
Mm-hmm. I think that tail risk is always a concern for some of these funds, because somebody comes up with an idea that says this can't happen except for 1 in 1,000 years. And then something happens that creates a long-term capital management situation. I don't know if you guys remember a few years ago, 5 or 6 years ago, I guess now, we had the inverse VIX blow up. All of these ideas work on paper, but the scenarios that people say are, 200 standard deviation, never going to happen moves, weirdly happen all the time. Yeah. So even though something that's supposed to happen, such a rare occurrence, it's because the normal distribution that people use on their markets really does a good job of understanding some of the most likely scenarios, but tail risk is much higher, I think, than most models will put out there. And so when something gets mispositioned, I hope the AI risk management can understand where that risk really lies. But if it doesn't, we could see another, maybe it's a financial instrument blowing up like the inverse VIX ETFs. Maybe it's just a whole riskless strategy like what the long-term capital management thought they had found, turning out to be a eventual bankruptcy for their fund. So Something like that, I think, is bound to happen, unfortunately, and just hopefully not being caught on the wrong side of it for everybody else is the importance.
So kind of moving back to some kind of practical strategies, what are some of your preferred option trading strategies in this current market environment?
Yeah, so because we've been in a grinding higher mode, I look at, basically in the money calls or call spreads, verticals, as a really good strategy for me. If the VIX drops a little bit more, call calendars really start to work well as well, with a directional bias. So a lot of people will sit there and look at calendar trades as being, if a stock's trading $100, they want to be in the $100 call calendar. I actually like using them as a directional tool oftentimes, where if I think that this stock is appreciating at 1% per month, I can then use an out of the money call calendar to take advantage of that and have a little bit of a directional bias along with that grind higher mode. So for me, I think right now it's more about verticals and can go into calendars if we're going to get much lower in the VIX. So, but I mean, overall, using options to define that risk by using long premium as opposed to short premium is a big thing for me, because short premium just doesn't pay in a low VIX environment.
Mm-hmm. How do you then adjust, your strategies based on that volatility and the market trends?
Yeah, so if a lot of times when we're in a trend, I like to try to buy like the low end of the channel. Just taking some of the technical advantages there and knowing that I can stop out of a trade if I get out of my technical setup. These are all really crucial elements in defining the risk, as well as making sure that I'm timing the market well. If we're getting 1% moves in the market or 0.5% moves in the market every day, that can be reasonable movement. But then if I'm looking to try to capture, say, 2% in a month on the market move, then I want to make sure I time the days right, so I'm not missing that 0.5% move or 1% move that some days might generate from fundamental inputs or technical. When I start to see a stock getting overbought, though, if I want to hold with it, I do need to adjust my strategy, whether that's selling an out of the money call against an in the money call, effectively a buy right. For those of you that know buy rights, you're basically selling a short dated call against a longer term position. Alternatively, I could look to buy a put if I think there's more of a pullback type scenario as a real hedge. That's a more structured hedge, especially if I've got a lot of long market exposure. Where I'm seeing tech right now, I think it can be a smart strategy right now to either be reducing long positions or hedging long positions, simply because we're overbought. We're going into earnings. So if we've got anything come up as a hiccup in earnings, those fundamental inputs are not where I necessarily have my personal edge. I have my edge off of the technicals. So I don't want to have max exposure when an input to the market's coming in that I don't have an edge on.
Now you mentioned, about managing risk being critical. Can you elaborate a little bit on your approach towards risk management?
Yeah, absolutely. So for me, I like to make sure I'm not overly concentrated in one single position. I think that's where it gets dangerous. I know Roaring Kitty did exactly that, and it worked out. But there are so many people you've never heard of to counter the Roaring Kitty story. I knew a lot of guys that, because of Reddit, they got excited about what happened in GameStop, what happened to Roaring Kitty, and they started looking for that same life-changing kind of trade where they could turn $50,000 into $5 million and quit their job and everything else. Unfortunately, for a lot of them, they lost their retirement account of $50,000 by trying to trade for an outlier that didn't happen. So first thing for me is understanding what I'm willing to lose. It's kind of like going to Vegas. If I am willing to lose $500 without being upset, then that's all I'm going to be using if I'm kind of playing around here with an outlier type move. If I'm using this as an investment vehicle, though, I have to also remember that this is not Vegas for me. This is not about playing a game. This is about long-term growth. So if this is my portfolio that I am using for my retirement, I cannot play games like GameStop and AMC and try to go off of those Reddit trades. That is the casino of the market. I want to have strategies that I can repeat and I could expect growth, and that I'm not going to have a 20% drawdown in my account in a week because I just timed something wrong. I have to make sure that I've defined my risk on each individual trade and on a portfolio basis. And if I only make twice the market return one year instead of 10 times because I didn't leverage it as much as I crazily could have, that's okay. Because over the long haul, I'm still going to have my money, and I'm not going to ever have that situation where I bust out my account.
You've been doing this for a long time. Obviously, you're well educated. How do you, somebody that's been doing it for so long, how do you stay updated? Like, who do you pay attention to, to continue to grow and learn?
Yeah. So as I go through a lot of the stuff, it's very easy to sit there and start saying, all right, I don't need to keep reading books or keep learning from new people because I've now got 20 years experience. But at the same point, it's most important to continue looking for that new input, like you said, that new person, that new voice. A lot of times for me, it's just talking to colleagues that are in this industry that are doing similar stuff, because they're the guys that were sitting there trying to, spitball what's going to happen next. How do we come up with the next new idea? And actually, one of the things that I often do is I try to listen to the mass media, the mainstream media that everybody else is listening to, because that's what's really being fed to the masses. And a lot of people do respond to that. Whether I agree with them or not, I can then react. So there are certain people that I know when they say something, the media, the masses respond very quickly and follow exactly that idea. Sometimes I want to follow that idea, and sometimes I actually want to counter that idea and say, everybody is now getting into that idea. I need to now take the opposite approach because there's nobody left to buy. So there's a whole number of different approaches you can take to that sort of opinion-based data. But I think just trying to stay on the cutting edge of what's happening, what advancements are coming in terms of, trading tools, artificial intelligence, and other strategies that people are employing can really help anybody really accelerate their learning and their market, knowledge, because the markets today act very differently than they did 20 years ago.
Any resources or platforms that you find useful or might be helpful for traders looking to improve their skills, their knowledge?
Yeah, so in terms of the educational stuff, obviously at Option Hotline we do have some educational tools and stuff that you guys can view, some videos, some instruction. In terms of some of the more, I guess, hard analytic tools, I use the SIBO Live Vol program. It's not free, but for a professional trader, it can give a lot of implied volatility data and things like that are not necessarily present in a lot of trading platforms. A lot of your trading platforms actually will have some really good technical trading concepts. You can use things like bar chart. You can use Market Watch to get an economic calendar. There's a lot of stuff you can piecemeal for free as well if that's what you're looking for. And then if you're looking for that next step, places like Option Hotline. I started working with a company called TradeSpoon that they do artificial intelligence-based signals. And that can help give you some idea of how professionals are looking at the market using technical signals, artificial intelligence-based signals, and then implementing that with an option strategy. So I kind of think of it as like having a swinging coach if you're a golfer. Getting out there and golfing is great, but having a guy standing there and watching you hit the ball and telling you what to adjust really can help you that much more and accelerate your learning curve.
So let's talk about advice for traders, especially the new trader. What advice might you give to new traders entering the options market today?
Yeah. So I think the first thing I would say is don't expect to be roaring kitty. You're not going to get this outlier return as easily as you think. And a lot of people actually that get an outlier return on their first trade end up going broke later because they get overconfident. So as long as you stay grounded, manage your risk and prioritize risk over reward, you have a good foundation for a long-term career. Find the people that you trust, find the style that you like. So just because one person's been successful in one strategy, if that's not the strategy that works for you, it may not be the right fit for you. I go back to the golf analogy. Some people are long hitters and some people are great around the green. If your best game is your short game and that's what gives you the most confidence, focus on making sure that you can drive the ball fine and straight, but make sure that you're taking advantage of your biggest strengths in trading, whether it's your risk management or your identification of technical trends or signals. Leverage that and then find somebody that can help you with the other side of it. We're not playing just the solo game as in that golf analogy. We're playing a scramble. Find somebody else that knows how to drive the ball, who can drive the ball for you, and then you can accelerate what you can contribute by focusing on the short game in that team.
And what maybe you could share, your kind of overall trading philosophy and how that's evolved over the years. What key lessons have you learned, from your trading experiences over all these years?
Yeah, so for me, the role in the marketplace really defines how you need to trade. So when I was a market maker, I was trading thousands of options every day, tens of thousands of options contracts every day. I'm not doing that anymore, obviously. First off, as a market maker, you don't really, you sort of have the option to choose some positions, but a lot of it's given to you. If somebody out there wants to trade United Healthcare and I'm a market maker in UNH, whether I like it or not, I have to give them a market on this option. And if they want to buy calls, and I did too, I had to give them a price that I was willing to sell them anyway. So I sold some calls and now I got to figure out how to react to that. So a lot of market making is about reacting. Now, the way that I'm trading and the way that I think most of you are, it's initiating trades. You find something you want to trade and that's what you're putting on. So it's a very different strategy from being in the reactive market maker position to trading, initiating as a retail trader or as a hedge fund trader. And in that point, as a hedge fund trader, very different trading than as a retail trader because there are trades you just couldn't put on for a hedge fund, couldn't get the size, couldn't get the liquidity. But when you're trading for your own personal account, there are smaller trades that can really actually be profitable. those are actually trades I like a lot for myself and for people that I work with, because for a hedge fund, it may not be worth the time trying to make that 3% in such a small size that they can't put it on because they'd move the market. For you and I, that's our role. We sit there and we can pick up the little pieces and find those edges and make that money that is worthwhile for us, because we're not trying to manage billions of dollars. We're just trying to manage a personal account and our own personal retirement. So, my strategies have really drifted from massive amounts of size to different ways of initiating massive amounts of size to now just trying to concentrate on the largest potential profit and the best expected value, and then really getting down into the minutia of putting on that trade the right way.
So maybe just a couple more questions and we'll wrap up here. But what is your kind of long-term outlook on the U.S. stock market? Let's say, we're getting past the election. What do you see? As far as this market, like you were talking about earlier, I think we're about 15 years into a bull market here. We've had some corrections. Maybe someone will call that 22 was about a 30% decline, right? Maybe that's technically a crash. But overall, right, since April of 2009, I think it was, right? We've pretty much gone up. Is this going to continue, or do you see problems ahead beyond the election and all that?
Yeah, I mean, I think that these problems sneak up on you when you get complacent. So it's going to happen. I don't know when. I don't know why yet. Somebody out there has probably identified another potential reason for the market to collapse. There's always somebody out there that has a extreme bearish view on the market. Sometimes they come to fruition, like the Big Short. Sometimes they don't. Most of the time, they don't. In reality, those things are hard to predict, because you're going to predict 10 of the next 2 recessions. So you're going to predict 10, and unless those other 2 will offset your losses from betting on recessions when they don't happen. So for me, it's more about just monetizing the trades as they go and defining that risk. I think that the market looks like it wants to keep going higher, but I do have my concerns. I mean, I can go back. I've thought for years that this whole notion of too big to fail that applied to the banks 15 years ago should apply to a number of tech companies today. That doesn't mean that it's going to apply. It doesn't mean that they're going to fail. I'm concerned, though, when certain big companies are so big that if they did have a real problem, that could really drive down the market and the economy. I hope it doesn't happen, though, and I'm not going to predict it happening, because, frankly, I don't know what would cause, Amazon or Apple or Microsoft to collapse. It's just, I don't have that fundamental knowledge, but I can know that there's a tail risk out there, and just always keep myself prepared for it. Like you said, there's going to be something that's going to cause a collapse. Maybe it's in the tech industry, maybe it's somewhere else. But for me, I've got to just kind of go with the flow and prepare myself for a rocky future and not over predict it. Because if I sit there and get this anxiety and this expectation of it happening, then I just position myself to lose until it does happen, and that's a hard way to ride your trading account. Sure. One sector, though, that I do think could be kind of interesting is biotech, and I only say that because every time I see a commercial these days, which is rare because most of it's on streaming, but most of these commercials seem to be for biotech companies these days, which means to me they must be making pretty good money. So it's certainly a sector that I think has potential for growth, because there's so much money in the medication industries.
So let's talk, if we can, a little bit about your future plans here with FFR Trading. In the past, you've done a great class, kind of a beginning and advanced options class for us. I've sat in some of those sessions. Fantastic information. You really reveal a lot of what you're doing and how you're doing it. Anything you can reveal about maybe some upcoming projects with FFR here, or products or services that you might offer to FFR Trading clients down the road here?
No, absolutely. So right now we're working on a partnership with a company that is run by a financial engineer. So he's been working on artificial intelligence there. I mentioned before, it's called TradeSpoon. And the guy that's running it, his name is Vlad. He's a great guy, great financial engineer, really knows a lot about artificial intelligence and applications to the market. And we recognize that this was one of those opportunities, my golfing analogy, the scramble, where he can bring in some financial engineering background. I can use my background, and we can probably put together a pretty powerful trading program using our two expertises combined. So that's something right now that we are working on developing, and it's in some of the initial stages of back testing and things, but we're seeing some pretty good potential for it, and I think we're going to have a pretty good trade composition idea that's going to come out of this partnership using the power of artificial intelligence and the knowledge of options trading and potentially complex structures and how to really leverage those moves. So I'm excited about that.
Yeah, that does sound exciting. I'll be certainly looking forward to that. And well, Keith, thank you so much for sharing, your valuable insights with you today. I think we covered a lot of ground, a lot of different topics. Really appreciate your time and look forward to hearing more from you in the future.
Absolutely. Thanks again, John.
All right. Take care.
You too.